Hello and welcome to our discussion on cash flow statement. Cash flow statement is one of the important financial statements. It is always useful to understand the cash along with the profit of a company. But it is important, equally important to understand that the profit depends on the assumptions or the generally accepted accounting principles like accrual and matching. So there is a possibility that the profit can be managed by managing these assumptions. Whereas cash flow statement records the actual cash flows. Therefore, it has often been said that cash is real, profit is surreal. And there is an accounting standard which governs the cash flow statement. In India, it is IndAS-7. And in this session, we will try to get a feel of the cash flow statement with a very simple exercise where all the financial statements are given. And we know that the cash in hand is equal to all receipts minus all payments, and cash in hand is transferred to the balance sheet. But the IndAS-7 says that preparing cash flow statement by showing all receipts and all payment is not very useful. Therefore, there is a need to show and classify the cash flows into cash from operating activities, cash from financing activities, and cash from investment activities. So that means IndAS says classify the cash flows on the basis of the business decisions. So here we have put all the receipts and all payments. Now what we will do is to classify these receipts on the basis of OD, FD, and ID, and in the process derive cash from operation, cash from financing, and cash from investment activity. So let the focus be on the cash flow statement only. So cash from operating activity is the net cash flow, all the receipts from operation and all payments from operation, net of that will be cash from operations. So observe this here. So there is only one cash inflow, which is a operating activity. So that is a sales. So sales is a cash sales is a cash inflow from operating activity. No other capital, loan, and dividend are not from operating activity. Payments, similarly, we have to identify the payments from arising out of the operating activity. So the first one is a stock of goods. Payment for the stock of goods is a cash from operating activity. The payment for the commission for the sales, commission on sales, so is an operating activity. Payment towards rent is an operating activity, but in this case, there is no rent paid. Similarly, interest is not an operating activity. Dividend is not an operating activity, but the tax is an operating activity. So the summation of inflow and the summation of outflow will show the receipts from operations and payments from operation. The payments from operation is 63,250 and the receipts are 150,000. So cash from operating activity is 86,750. So let us recap. So the operating cash flows are sales, purchase of stock, payment of commission, payment of rent, which is 0 here, and the payment of tax. So 86,750 is a cash from operating activity. Now let us observe the cash from financing activity and cash from investment activity. The cash from financing activity is a net result of financing decisions. What are financing decisions? Raising capital, repaying capital, borrowing, dividend, interest. These are all financing activity. So if you observe in this case, you have raised capital. We raise capital. So capital is a receipt from the financing activity. We raised loans. So loans is a financing activity. The summation of receipts from the financing activity is 250,000. Payments, there is only the payments with respect to the interest and with respect to the dividend are the payments from the financing activity. Because in this example, there is no repayment of loan, no buyback of shares, no payment of dividend. So therefore, the cash outflow because of the financing decision is only 5,000. So cash from financing decision, the net cash flow from financing decision is 245,000, 2,45,000. So CFO is 86,000, CFF is 245,000. Now let us find the next one, that is the investment decision. The investment decision is a result of acquisition of assets, the sale of assets. So observe here, we have only received dividend, which is a result of the investment decisions. The payments with respect to investment decision is the acquisition of shares. We have not purchased any plant or we have not purchased any other investments. So the only investment is the purchase of the Tata Steel shares, and only receipt is the distribution or receipt of dividend. So therefore, the cash from investment decisions is 82,000. So CFO, the cash in hand, is 249,750, which is receipts minus payment. But according to the accounting standard IndAS-7, it says that you should always classify the receipts and payments into operations, financing, and investment. It is mandatory. Every company is bound to show the cash flow statement, which will reflect operating cash flows, financing cash flows, and investment cash flows. So let us observe some cash flows of Indian companies. So cash flow statement for Infosys, we can see that CFO, CFI, and CFF. Let us take one by one. The cash from operating activity of Infosys has increased from 4,000 crore to 23,000 crore. That means the Infosys has been generating cash from operating activity for quite some time. And what are they doing with that cash? They're using the cash for investment. The negative cash from investment activity means there is a outflow is greater than inflow, and outflow under investment is acquisition of assets. So therefore, the negative CFI is a sign of growth, is a sign of growing company. And why is CFI negative? CFF negative. CFF shows the repayments of loan, buyback of shares, interest paid, and dividend. Whereas in case of Infosys, we can see it's to a large extent because of the dividend, because of the payment of dividend. So negative CFI, negative CFF, and positive CFO is a sign of a company which is generating cash flows from operations, using that money to create assets and also distribute dividend. But let us observe some other company. So let us see a company like Paytm. Okay, Paytm was in news recently because it came to the market. It made its first IPO. But we can see that Paytm is still having a negative CFO. That means Paytm is not able to generate cash from its operating activity. But Paytm has a big amount of negative CFI in 22. The negative CFI is a reflection of creation of assets. But where is the money coming from? Negative CFF, sorry, negative CFO and negative CFI. But so where is the money coming from? It's coming from financing activity. And you can see a big jump of financing activity, 8,000 crore. So where did this money come from? They went for a public issue. The proceeds from the issue of shares, right? And you can see that this data is from Screener, which is a publicly available data. This is also the case, like Infosys, other established company like Tata Steel. We can see that Tata Steel is also having positive CFO, consistent, negative CFI, consistent negative CFI, and consistent negative CFF. So that means the business is generating huge amount of cash flows. So therefore, understanding cash flows is very useful in understanding the business. For example, let us just observe, come back to this. We see cash in hand 249, PAT is 92,000. Let us see the variations of that. So see the situation too. Same cash in hand, same PAT. But the company is having negative CFO. The company is having negative CFO. It's possible, therefore, the profit is same, cash in hand is same, but the composition of this cash in hand may be different. So it is the same company, same cash flows, similar cash in hand, the same amount of profit, but observe the CFO positive and here CFO negative. So it's always important not to just observe the income statement. Your company may be having profit, but that profit they may not be converting into cash flows. So for the purpose of analysis, it is not just enough to see the profit. It's also useful to understand the cash flows, because the cash flows, as per the accounting standard, every company is bound to show CFO, CFI, and CFF. So henceforth, when you open an annual report, observe the balance sheet to see equity, observe the income statement to see the profit, and observe the cash flow statement to see the composition of the cash flows. So understanding cash flows is therefore a very important aspect of the financial analysis. We'll examine the cash flows of few more companies and the complexity of relationship between cash flows and PAT as we move along. Thank you very much.